So, I'm Alicia Odie, Managing Director of Rev One. I am being joined today by several of my colleagues. We have John Schroepfer, Parker MacDonell, Wade Embry, and Ryan Helon. And our topic today is the CARES Act. So quickly, we're going to do a quick CARES Act overview, telling you about what programs are available now and what you should be doing and thinking about. We'll talk a little bit about SBA banking ins and out, and then dive deeper into the affiliate rules that impact a lot of our startups. And then at the end, we'll do Q&A. So we are going to ask that everybody mute yourselves. If you just mute yourselves for the rest of the call, and I'll go ahead and do that if people have issues. Send Q&A, send your questions through the chat function. So you can either send it to me privately or just send it to the whole group. I'll collect all of those, and in our last 15 minutes, we'll go ahead and I'll ask those questions of the presenters. With that, I'm going to turn it over to John Schroepfer.
Yeah, thank you, Alicia. Appreciate everybody's patience with what occurred. But moving on, I just, our purpose today was to continue to give our clients and the community some information that we learn on some of the ways that companies can really survive in this environment. And before we get into the specifics of the CARES Act, I think it's good to place this into context, that we believe this is part of many different options that companies ought to be pursuing to make sure that they survive this this period that we're in. And some of these programs may be applicable for you, they may not be, but we encourage you to look at them closely and encourage you to look at all the other options, including funding from friends and family and any other sources that you might not have considered in the past. So with that, I'm going to give us sort of a quick overview of the CARES Act and those aspects of the CARES Act that might be applicable to our clients and small businesses in general. Starting off with, there's really two relative or relevant aspects of the CARES Act that has received a lot of the focus, and the one is the SBA loan programs. We're going to cover that initially. And then we're also going to get into two of the new tax provisions that were created under the CARES Act that we believe companies ought to be including in their analysis. So first of all, real quickly going through, there's has been a program called the Economic Injury Disaster Loan Program that generally is a program that you can borrow up to $2 million under. Anything over 25,000 generally requires a guarantee by the entity or the entity's owners. Loans under that program are they do require collateral, but they're generally very they're 11 months deferred payments with 3 3/4% interest rate, so they're pretty attractive. But a lot of the collateral issues, a lot of entrepreneurs don't want to pursue that program because of that reason. But you might want to continue looking at that, because there's also an an emergency economic injury grant that is available under that same program that will provide you, while your application is being processed, would provide you with up to $10,000 in the form of a grant, and that would come to you in, according to the program, 2 or 3 days. So it might be worth pursuing just from that standpoint. The major loan program that we have been investigating is the Paycheck Protection Program. And this is the $349 billion program that has been rolled out under the CARES Act, primarily or entirely through the Small Business Administration, the SBA loan program, the 7A program specifically that has been in place, and that is the program that includes affiliate banks. And Parker's going to give us more detail about that in just a few minutes, but that's could be an attractive option for a lot of our entrepreneurs under these circumstances. There's no fee to apply. There's no prepayment penalties. It is an SBA guaranteed loan. It doesn't require collateral from the owners or the entity. And there's an aspect of forgiveness. If you meet certain conditions, the loan would actually be forgiven, which is really attractive. So a couple notes on the programs. You know, I think that we've all got to keep this in the back of our minds, is that the SBA, according to the Wall Street Journal, has administered $25 billion in loans at this point, and they've done that over a period of years. Right now, the SBA is being asked to work with banks to put $349 billion of capital out into the market very quickly in a period of months, if not weeks, to help the economy overall. So keep that in perspective. You know, the initial, every indication from the SBA and the Treasury is that they're going to use the banks, the bank program that's currently in place. But, you know, read up on this, keep an eye out. There might be some other alternatives that are introduced. We're coaching all of our companies to keep an eye out and look at the Treasury. They might create some direct lending opportunities to get the cash into the market very quickly. So there's been some progress, I think, with respect to the National Venture Capital Association has been pursuing making some changes to the rules that the SBA has had in place under the 7A programs with banks. It's called, most people know that as the affiliation rules. We're going to have a longer conversation at the end of this. So that's something that the National Venture Capital Association has been focused on over the last week. They have not made a lot of progress in making modifications to those rules at this point. And I emphasize at this point because they're continuing to work on it. But we want to get into that in a little bit in just a couple minutes. Two other aspects, or the tax provisions of this of the regulation, is really important for companies to consider as well. There's two components of this. The first is the employee retention tax credit, and it provides a 50% tax credit to employers for wages and benefits up to the first $10,000 paid to each eligible employee from the period March 13th through the end of 2020. So that's a program that might benefit a lot of our companies and the community in general. The other is an employer payroll tax deferral, which allows taxpayers to defer paying their portion of FICA. The employer's portion of FICA is 6.2% of the employee's compensation, and that would be effective from March 27th, 2020 through the end of the year. That allows employers to defer payment of those until they'll accumulate that and pay 50% of it at the end of 2021 and the other 50% at the end of 2022. So those are two tax provisions that companies need to keep in mind, and there needs to be, you need to look at this holistically. So keep in mind that you would not be able to take advantage of the Paycheck Protection Program and these tax provisions. It's either or, it's not both. So you have to do the analysis. Each company ought to be doing analysis to determine the greater impact, the greater effect on their cash flow. That's an important part of the steps that we're recommending. And the other part of the recommendations, the steps that we're suggesting companies take right now, is to reach out to their bank and make sure that you're in touch with your bank. And Parker MacDonell, I love working with this guy. He's a president was the president of a local bank for a long time. So I'm going to let him take this conversation and lead us in that. Parker?
Thanks, John. I had to reach for my unmuting. Thanks for handing the baton over, and thanks for the love, man. I appreciate that. Hey, I want to first of all start out by acknowledging that those of you who are on the call who are business owners or entrepreneurs have long been able to practice your flexibility skills, and the way things are changing right now, those skills really come in handy. So thank you for being flexible. And I say that because we're going to have to be patient and flexible with our banking partners. They're on the front line, as John said, of implementing this payroll protection plan loan, which is really at the heart of the loan programs that the government's offering through the CARES program. So the banks that I've talked to are working really hard to interpret the direction that they've received from the U.S. government on how to do this. And my sense is that at least some, if not many of them, are not yet quite ready to launch the process. They're doing things like adding staff and creating new processes, including those for taking applications and for making loan decisions. If you've looked at the SBA site for the Payment Protection Plan loan, it says lenders may begin processing loan applications as soon as April 3rd, 2020. So the key words there are may begin and as soon as tomorrow. I mean, so they're not really compelled to launch until they're ready to do so. And I think we all agree that even though the government wants them to act with expediency, that they're also they're going to set this thing up so that they're really prepared to deliver on it. So as John mentioned before, some banks in our community are already SBA approved lenders, and so they're going to be able to ramp up more quickly than others. For instance, we're lucky in our region to have two banks that vie for the title of biggest SBA lender in the country. Huntington is the number one in terms of number of applications, which is probably more relevant here. And Chase is number one in terms of dollar volumes of loans that are made throughout the country. So we're in the good hands of those two institutions here in this community, as well as a number of other great banks. But some of the banks that you may bank with may not be SBA approved lenders. And so the government is working to add additional banks to this program. We don't know how they're going to do that or how long it's going to take. So the first piece of advice that I've got for you, if you're thinking about embarking on an application for the payment or paycheck protection plan loan, is to contact the bank where you've got your business checking account. If you've got a business, you probably have a business checking account. And if that bank is going to accept applications, or perhaps by the time you reach them, they're already accepting applications, that's great. If they're not, for reasons I'll explain in a minute, you may have to be patient and wait until they're set up to accept these applications and hope that they do get accepted to do that. And so why am I saying that? Well, what I've learned is that one of the major concerns that our banks have is that they are trying to prevent fraud from happening. You can imagine that this is as we saw just a few minutes ago, for those of us who are on the first version of this call, this environment we're in is rife for all kinds of mischief and mayhem and fraud. And banks go to great lengths to try to prevent fraud. They're compelled to do that through a number of regulations, one of which is called Know Your Customer. And some of you have gotten calls in the past from your bank so they could comply with that regulation. So the issue here is that the banks really need to be able to authenticate that the customers who are opening accounts or who have opened accounts with them really are who they say they are. And since the mechanism for funding your loan, should you get one, is almost certainly going to be a direct deposit into your existing business banking checking account, then it's likely that banks are only going to make these loans available to businesses that have already set up a business checking account with them. That's because the bank presumably has already gone through the authentication process if they're following their P's and Q's. So that's a long way of saying that the banks may, if your bank is not set up to take a loan application now or in the near future, and you start looking for other banks, you may find out that they're not going to be able to take on new clients because they just won't have the time and the resources to set up and authenticate a new business, a checking account for you while they're ramping up to take what they believe will be a massive onslaught of loan applications. So this is the best information that we've got at this moment, and as that unfolds, we'll tell you more. So let's say that you get in contact with, or have already been in contact with your bank, and you want to do everything you can to get ready for that. Well, the first thing you can do is go to the SBA website, look for the landing page about this loan program, and you can actually go there and download a sample form to see the information that will be requested of you. However, I want to caution you, this isn't the application you need to fill out unless your bank tells you they're going to use it. The banks that we've talked to are planning to customize this form for their own purposes. So once again, talk to your bank, whether that's through a phone call or a chat on their website. So if you are getting ready to do the application, or you're planning to make an application because your analysis of the options tells you that this is your best option, there are a couple things that you're going to want to have at your fingertips. First of all, the IRS has a form called the 941. That's an employer's quarterly federal income tax return form, and either your payroll company has been preparing that for you, unless you for some reason are doing it on your own. So a call or a reach out to your payroll company would be in order here. And then you're also going to want to get a breakdown of your payroll expenses starting back in January 2019 and probably taking it through February or even March of this year if your March payroll expenses are closed out. You're, of course, going to want to have complete financial statements for 2019, primarily a profit and loss statement and balance sheet. And that will be information that your bank's probably going to want to at least verify, if not analyze, in order to get the loan approved. Now, in a minute, we're going to talk about this the topic of affiliation. When you go look at that sample form, if you haven't already, you'll see that there's some questions about affiliation. We're going to talk about that in a minute, but in order to get prepared for that, you'll hear this again later in the call. We recommend that you make sure that you've got the most recent version of your capitalization table, also known as cap table. That's a listing of every entity and person who's invested in your company, whether that be an equity investment or some kind of a loan that converts to equity. You're going to want to make sure that you got your hands on your most recent certificate of incorporation and your most recent investor rights agreement, because it's possible that on the advice of your legal counsel and your bank and at the suggestion of your bank, you may decide to ask your investors or certain investors to allow you to make amendments to one or both of those documents in order to get approved for the Paycheck Protection Plan loan. So just a couple of final words before I hand the baton back over to my colleagues. First of all, you may have already experienced this. Your bank is probably overwhelmed right now by calls. A lot of small business owners who've got checking accounts only with banks don't have an assigned loan officer, so to speak, or a banking officer, and deal primarily with the branches. So if you can't get anybody on the phone because they're overwhelmed, or if the person you get on the phone doesn't have all the knowledge that you wish she or he had, look for a landing page on your bank's website to see if you can get more information from them about their application process, when it's going to start, what information they're looking for. And there might also be a way for you to get in the queue at that bank. In other words, reserve a spot for an application, so when the bank does start taking applications, you'll have a spot in line. The last thing I'd say is that banks really are trying to do the right thing here, and I hope as a former banker you'll understand that they are trying to do the right thing, and you'll be patient with them. I look at banks as being the moral equivalent of the healthcare workers who are out there in the front line, really taking risk with their own health and lives every day to help sick people get better. The bankers aren't taking that same level of risk, but they are the front line for our financial health if we're deciding as entrepreneurs to apply for these loan programs. So, end of speech. With that, I will hand it back over to either Alicia or Wayne. Alicia, I'll let you take the baton and tell us who's next.
All right, Alicia, I'll go ahead.
John?
Yeah, thank you, Parker. Appreciate that. I just wanted to make sure that we start off with all of what we've said so far is on the Rev1 website. I think there was a blog posted yesterday that you can refer a lot of these programs, but just to quickly summarize the steps, we need to do, every company needs to do the analysis in terms of whether they're going to be taking advantage of the Paycheck Protection Program or the tax provisions. You can apply for the loan before you make that decision, wait for the terms to come back and see which provides the most benefit. So approach your bank, as Parker mentioned, all those steps. In the first on that application that Parker referred to, there's questions around who owns 20% or more of your business, and that gets to this whole issue of affiliation, which we want to get into next, and which is the next recommendation in terms of the practical steps that companies should be taking if they're going to consider the Paycheck Protection Program. You need to look at your cap table and determine who passes that 20% interest test. And just keep this in mind. This is a definition that is provided by the SBA. It's not going to be found in legal text, or it's not going to be found in IRS rules. It is an SBA defined term. There's no black line. It fundamentally comes to the issue of control. And a lot of the control issues are addressed in the governing documents that Parker mentioned, articles of incorporation, investor rights agreements. So we have on our website the National Venture Capital Association guidance with respect to practical steps that you can take to look at those documents, to find the right terms in those documents, the right the right parts that will guide you to the right parts of those documents to help you get clarity around this issue of control. So, Wayne, can you elaborate a little bit more on some suggestions, or maybe just some advice for entrepreneurs when they go and begin looking at these documents, and from your experience with dealing with some of these affiliation rules, provide some wisdom? Wayne, I think you're on mute. I can't hear you. Wayne, you're still on mute.
Wayne, you should be unmuted now.
He's talking. I can't hear him.
He's not. I don't have him muted.
Okay. Well, Ryan, I know that you've had some experience dealing with a couple of our portfolio companies. Can you can you share some of the some practical advice for those on the call?
Hold on a second. Brian, you should be unmuted. I can't hear you though.
Okay. Well,
Sorry.
Apologies to everybody. The suggestion is to take a look at your cap table and look at the control rights, specifically the rights that some investors might have to impact certain transactions, possibly. Remember, the issue is around control, and that 20% is just sort of as far as I understand, it's not a black line. So in other words, if it's 20% or more, you fall into this category. If it's 20% or less, I think you have to look at those documents, the preferences that are given to certain classes of shares in your articles of incorporation, and then specifically any transaction documents that might pass control to investors through typically the investor rights agreement. Look at those documents, review them carefully with your counsel. We're recommending that that companies do that in conjunction with their counsel. Those companies may have to make modifications to those documents in order to overcome those control issues, and that's when it becomes time to work with your investors to determine whether or not they, first of all, would be willing to make those changes. Hopefully they would. I know that we would under the right circumstances. Work with your counsel directly and determine what control aspects need to be addressed in order to meet the SBA requirements. Parker, I know we can hear you. Anything you want to add to that? Now it sounds like Parker's on mute. Okay. Well,
Alicia, can you hear me now?
Yes, I just unmuted everybody. Hello.
Hello?
Oh, yes, Parker or Wade, I can hear you now.
You can hear me? Okay. Just to follow up on what John was saying, this is a very dynamic, moving target. Right now, the National Venture Capital Association, Nancy Pelosi and Kevin McCarthy, I know there's a combination that you didn't think would work together necessarily, but they are working together to come with a legislative resolution to this. I think they've heard enough from across the spectrum of companies that have received equity investment from a variety of sources that to throw everybody into the same bucket is not going to help solve this problem. And so we're staying on top of that. I just sent around to the Rev 1 management team an update from one of the news sources that we follow very closely. You'll notice that Matt Reed just sent around a link to an MVCA document that provides guidance on this. We can't overstate a couple of things. Work closely with your legal counsel. Make sure your legal counsel is up on top of this, and start that immediately, because the issues that Parker identified and laid out and that John did with respect to the banks and the timelines are going to be critical. There are going to be caps on this program. and you want to make sure that you're moving as quickly as possible. So having all your documents in place, having calls into your bankers is important to move forward with this, and do everything you can to take advantage of a program that should meet some of your needs.
Any thoughts, comments from Ryan if he's unmuted? We want to go to questions. Do you want to address some of the questions, Alicia?
Yeah, I'm not actually seeing any questions coming through. So if anyone has questions, please go ahead and send them via chat.
Well, while that's going on, let me toss a question out to Parker and John. In the process of reaching out to the banks, some banks are specifically, as in the case of Huntington, SBA approved banks. How do you find out if your bank is an SBA approved lender? And if they're not, even though they may be a major bank, how do you deal with that as quickly as you can?
Wayne, if you can hear me now, the website that the SBA has set up for this loan program has a link on it that does show the list of the 700 or so banks in the United States that are currently approved to make these kinds of loans. So if you can't get in touch with your own bank to get them to answer the question, you can look there, and perhaps we should send out a link for that. And I'll look for it when we finish up this comment.
What about other threshold tests that could potentially exist, John, regarding the program and applying?
Threshold tests for the Paychex program?
Yes.
I'm trying to think of if you know of some, Wayne. What there's go ahead and throw them out there.
No, I don't. That's why I was. I know that you and Parker have been really diving into this. So I just wanted to make sure if there was something else that we hadn't necessarily already talked about. Was there anything else that you might know about?
No, I think this program is designed to help companies. And I think there is going to be part of the forgiveness formula is based on how many of the employees you carry on for the next 8-week period. So that's going to be important that you sustain your payroll as is for a period of at least 2 months after receiving the loan, and that'll feed into how much is actually able to be forgiven in the future at some future point. But the real the issue that I think is really that control issue, and 20% is when I think companies need to begin looking deeper into the issue of control and see if it exists in their governance and investor documents.
We've got a couple of questions. Yep.
We do have some, yep. So does that 8-week period start at the time the loan is funded, or is there another date?
Well, my understanding is that it is the date of the loan. So whether it's the same date that it's funded, it might be off a day or two, but it should be very close. It's the date of the 8-week period begins the date of the loan.
Okay. Is there a rule of thumb on trade-off between tax credit approach versus PPP loan?
No, I think if you look at you look at your average if you look at your payroll and look at what you have paid in the past year and take about 75% of that, keep in mind that that's a deferral. You're actually going to have to pay that. It's not, you will have to pay it a year out in 2021 and 2022. The tax credit is a source of cash flow. It's not a deferral program like the other one is. So as far as I understand, you can take advantage of both of those tax provisions. They interplay a little bit, and to be quite honest, I haven't worked through an example to see how those interplay. I think there's still some questions about that, but no, to answer the question, there's no rules of thumb. I think you have to go through the analysis in order to come to some conclusions. There's no short answer for companies.
Okay, and then has anyone heard the exact 12-month time period? Is it 2019 or prior 12 months ending 3/31? Not sure what that means.
John, I'll take that one if you'd like me to. I think that it depends on when your business started. If your business started prior to 1/1 of 2019, then I imagine that the bank will probably look at your total payroll for the year 2019, and after you've made adjustments to exclude the salary and related costs for employees that made over $100,000 during that time period, then I imagine that they'll just probably take that number, divide it by 12, and multiply it by 2.5. But if you started your business sometime later than, if your business wasn't in existence on the first of the year, 2019, there's probably some kind of a pro rata calculation, as best I can determine. And again, that's one of the things that I think the banks are really trying to make sure that they've got in place before they actually launch a way for their customers to make applications. Because once you make the application, they want to be able to say yes or no really quickly and be able to fund the loans that they approve really quickly.
Yeah, on top of that, Parker, I think there's some, if a company is somewhat seasonable or seasonal, I think there's some flexibility that the SBA provides in terms of what that look-back period looks like. But I think the direction is correct, that if you're relatively new, the period is immediately in the last 3 months or 6 months maybe. But if you've been around for a little bit longer, I think they go back to the same 12-month period that you referred to.
Let's see if Ryan is able to talk yet. Ryan, can you try to unmute yourself now?
I will. Can you guys hear me?
Yes.
Yes.
Amazing. Well, I don't have a lot. My colleagues, I think, done a really exceptional job hitting on all the key points. I just want to reference again a document that Matt Reed, one of our portfolio company executives, shared on the Zoom chat. It's a document from the National Venture Capital Association on the affiliation rules. I really think it's the best and most clear guidance we have. And while I would echo Wayne's comment that there is a lot of talk in the works about modification of the affiliation rules and how they might apply to this specific program, the best we know today is the letter of the law, which is kind of what this analysis from the NVCA walks through. So I'd encourage you guys to look at that if you want what I think is the best sort of primer on how those apply in this context. And it really comes down to control, and they even have some nice tips when you're engaging with your bank to really discuss, well, my minority investors, have some rights, but they don't control the day-to-day operations of the company, because that's really what SBA is trying to get at. And they do it with sort of a blunt force approach, but they're really trying to ensure that a venture capital firm that's invested in your company doesn't really exercise control across the day-to-day decisions of the business, which to be honest, few venture firms do, but the way they've defined these rules, it could catch activities that don't constitute day-to-day control and kind of bundle those together. So again, I'm echoing a lot of what you all have heard today from John and Wayne and Parker, but it's always good to try to educate yourself. That's usually a worthwhile investment. That'll make you more fluent when you have that conversation with your lender. But as Wayne described, this gets into the weeds of corporate governance documents that hopefully you understand your corporate governance documents, but you're probably not well suited unless you're a corporate attorney yourself to really interpret what modifications might be required if this does emerge as a risk for your eligibility for the program.
Great. Thank you, Ryan. Any other questions? Last chance to submit. All right, any closing thoughts as we wrap up?
I think we're going to try and keep a lot of this information and a lot of the documents on our website, Alicia. And I would suggest anybody who maybe is looking for some guidance. A lot of what we said is sort of rehashed in some of the information on our website. So you can find it there.
And then,
yeah, John, just to follow on that, the link that I sent out via chat to everybody is a link to a blog post that contains that information. So if you, it's actually not on the COVID-19 landing page on our website, but it's over in the blog landing page. So that's where you go to find the information.
and because we're plowing new ground every day here, any of you learning something, if successfully going through this process and finding what worked, what didn't work, as quickly as you can share that information with us, we'll get it out to your peers. I think that's going to be the best way for all of us to learn in the near future, is from your own direct experiences. And so as quickly as you know something that you think could benefit the community, please let us know.
Okay. Thanks, everybody. We will make this recording available later on our website. And stay tuned for more notes from Rev 1 on upcoming programs. So thanks, everybody.